and then
Yeah.
I think none of us will get the feedback.
Yeah. Yeah. Cool.
All right, so we're starting like 20 minutes late. You wouldn't believe that I turned I wanted to mute notifications on my phone, and I have a OnePlus phone. So I activated this thing called Zen mode, which is like you shall not be disturbed while Zen mode is active. Turns out Zen mode locks your phone completely. And you can't, there's no, other than like factory reset, you can't turn it off. So, um, so I was literally locked out of my phone for the first 20 minutes of this Twitter space. But now we're in action. Mayank's speaker is completely messed up. So let's see how this goes, guys. Like we're off to an amazing start.
Yep, and that was an epic GG moment for a game company founder.
Yeah, at that point I was like, okay, just cancel. Yeah, so anyone who's joined, I'll invite you guys up to speak as well. If you just check your phones, you should be able to, you'll be able to sort of see the invitation, accept it, and kind of join us just to chat. So, who do we have? Let's do some. Oh, hey, we have one person who's just jumped on. Dialectic Research. Thanks for joining us.
Thank you, Oliver, for letting me join.
No problemo. So we're talking about, to get on topic, surviving the startup apocalypse. I think this is more of a niche topic that really is on the minds of many founders or people looking to do startups or working in startups today. And Mayank and I are sort of both early stage founders. Mayank has the added bonus of maybe, Mayank, you can sort of introduce yourself to everyone in the room.
Yeah, sure. I switched to loudspeaker. Is this better for static background? Just last check.
This seems great.
Oh, okay. Might be something with my headphones then. All right, perfect. So thanks, Oliver, and welcome everyone. My name is Mayank. I'm founder of Outscal. Been in the gaming space for over a decade now. Worked with a lot of different kind of companies, different kind of games. Now I run an edtech startup at the intersection of edtech and gaming. EdTech is going through a rough patch, as some of you might know, who've been following what's happening in the market. So definitely an interesting conversation, and happy to answer any questions as we go along. Oliver, you want to do a quick intro?
Yeah, just a quick intro for myself. Then, co-founder, CEO of Bombay Play, early stage. We can still call ourselves early stage at Series A, I think. Gaming content company. We've been running now in Bangalore for about over 3 years. We're about 50 to 60 people, and we just announced our Series A sort of. I think it was last month, or no, actually month before. Yeah, we're in early June now. So that's us. I think it's interesting to have edtech, gaming and edtech kind of represented here. I think it's recently e-commerce, edtech have faced the most severe corrections, and it's not even sort of halfway through the year, and the funding sort of news, or I guess VCs have been warning us about like a market correction for some time, especially throughout last year, as valuations started skyrocketing, money was raining from the sky, people were getting funded left, right, and center, and then I think those who still had their common sense warned that there would be a correction at some point, and here we are, it seems. And now we're seeing massive inflation in the US, VCs sort of yanking back the like closing their wallets, taking things carefully. There's a lot of fear, and it's already translated into into layoffs. In India, especially, I think the number is over 8,000 layoffs just in the last few months alone, mostly in edtech and ecom. In May, just in May, that was nearly 3,500 layoffs alone, and across like 18 startups. We're not even started here. Like this, when the market goes into a downturn like this, I think, in fact, I'll just throw the question to Mayank here. Like, how severe do you think this is? Will this be a blip, or is this for the long term?
Yeah, I think before we jump into that, just one thing I'll add is specifically because Outscale and my focus has been especially at that edtech intersection, right? So if you look at the landscape of the startups that you mentioned, are facing the brunt of the heat, right? Majority of them are actually in the K-12 segment, right? They were offering sort of like coding classes for school students, right? And I think it's always important to remember when you're doing a startup, right? Like whether this is something of a vitamin versus a painkiller, right? Like it's a very common concept in the early stage startup ecosystem. And there, it was definitely not a painkiller. During COVID, we saw a peak in edtech, industry investment space, primarily into K-12, right? Why? Because so many kids were at home, parents wanted their kids to do something, and everybody was signing up for these coding classes and AI classes and whatnot, right? But if you look at on the other side of edtech, companies that are really solving a painkiller point, around the job economy, future of skills economy and all, right? With gaming booming, a lot of demand for new kind of career opportunities there as well, right? Those have rarely felt anything, right? Especially from a customer segment perspective. As long as the customers are there, VCs will eventually come along, right? Because that's what currently, always will help grow solid businesses, right? So that's why all the layoffs and everything that you see are heavily predominantly in the K-12 space. If anyone has any,
most of these edtech companies, sorry to interrupt you there, but most of these edtech companies that were funded during the pandemic, like it wasn't very clear. You're right. Like what was the real value they were offering other than Zoom classes? There was no sort of that was the temporary need of the hour. But I think we recently heard news of the company Uday shutting down, and it just didn't seem to have anything proprietary other than sort of classes that were online.
Yeah, no, 100% agree. I think proprietary though even is like far-fetched. They didn't even like a lot of these, not specifically picking on like a specific name or something, but a lot of these don't even have anything unique, right?
Right.
Like it all kind of started from Baiju's acquisition of what was the name?
White Hat Junior.
White Hat, yeah, White Hat, right, exactly. So the frenzy kind of started from there, right? And but I think again, right, if you have solid fundamentals, that the problem that you're trying to solve is deep, and it's kind of ironic that we are talking about games companies and the gaming
we're
ecosystem,
solving a real
and
problem, guys.
yeah, but I think I can very strongly argue that the game companies do solve a very sort of strong fundamental humans, but slightly more of a philosophical discussion on that side, right? What kind of a problem it is really solving. But yeah, like if you have that problem that you're solving, then I think these downturns, you don't feel it, right? Like even for us, right? We understand what space we are in, how we are supposed to grow, what our fundamentals are, right? And that's where we're very undeterred by in terms of what happens in the market, because we know these trends will shift up again and again in X months, whatever that X value is, right?
I think it's probably useful to sorry.
Yes, Vivek, please.
Yeah, so I think it's probably useful to make a distinction from a financial perspective on how gaming sort of differs from edtech. If I were to like look at gaming companies in general, right? So there is the studios in the early phase of product development where your cost of operations is still a lot on like production and development at this point of time until we really hit a point where there's product market fit, then you really start pumping into user acquisition in order to scale. So the cost of revenue is not equal comparable for edtech, I would argue, even though a lot of fundamentals of product development remain the same. Because if you look at the publicly listed edtech companies, right, their cost of revenue is fairly high, especially because a lot of them have highly sales-driven models, and especially since the pandemic has closed and schools have started opening up, a lot of that revenue has started becoming in question, right? So the PE compressions over there makes a lot of sense, but I think I still continue to be bullish on early stage funding for early stage gaming companies, primarily because there is a clear path to revenue. There has been success in the freemium space, and these large launch pads and early stage VC funds in the Series A, seed stage funds, especially focused on Web3 gaming, are still able to write check sizes enough to be able to fund probably a fairly young game studio who's working on new product development, maybe. And I don't see that really sort of drying up completely for at least fairly talented development teams that are coming into the market right now. But probably the real contest really comes in when your probability of your outcomes really becomes more and more in question, right? So the risk capital sort of moves away from the more riskier bets into probably, let's say, a shift back into more freemium style games at this point of time compared to Web3 games. Not sure, but super excited about, especially from you, Ollie, because you are from a freemium background and looking into Web3. So
Yeah.
how are you currently thinking around that?
Yeah, actually quite, there does seem to be, well, in times like this, a lot more sanity returning to the market. There was a lot of money chasing Web3 for sure, sort of, well, early this year and also throughout all of last year when it came to sort of blockchain gaming. It does seem that now VCs, the mindset, at least among VCs and angels like myself, we're looking for companies that are a bit more proven, and also business models that are a bit more proven with like good solid teams behind. So you could say it's hopefully this will translate into more money coming back to sort of casual gaming, well, content businesses. It always has been rather tough for content, but I think last year was a bit of a bloodbath as a lot of that money went into sort of Web3 content versus sort of free to play. Yeah, I think just to so yeah, I am quite I am hoping that this will be a positive thing for the content, that I guess the game makers. We've also seen, I am sort of skeptical about how businesses without strong fundamentals will continue to survive. I think game streaming is another area which I think we do have some VCs in the call, I see, but there was a recent announcement of LOLO, which actually, well, that's an awesome business, by the way. Congratulations to the founders for their fundraise. I think it was 13 million announced yesterday. But I think businesses like game streaming, I'm not sure what the path to revenue is. Those businesses for sure, I think will have to sort of accelerate their roadmap to profitability, as well as many others. I do the second thing I'm rather that troubles me is pre-product companies just simply. I think it's going to be harder to bet on simply strong teams. Will capital go to businesses that are still sort of a year or two away from profitability? I'm not so sure. So I realize actually we've got Harshit from Kalari who's joined the call. So I've just invited you to speak if you want to add on that, Harshit. But yeah, a question for you guys. I think firstly, should we be taking this seriously? How seriously should we be taking this downturn? Should we just continue as business as normal, or should we be sort of correcting now and preparing for doomsday? Mayank?
Yeah, I think that's that answer changes from whose lens you're looking at from, right? If you yourself are a founder, right, and I'm going to answer it from a founder first perspective itself, is that you just need to know what you're building for exactly, right? And are you going to be always dependent on external capital to sustain, right? So I think if you're right now, as of today, if you have a studio where your fundamentals don't get you to this concept of default alive. So, if somebody's not familiar with what default alive is, essentially it's an essay from Paul Graham, founder of IC, which basically just says that you need to project your growth rate and based on the cash that you have left in the bank, before you run out of cash, you'll hit profitability, right? So as simple as that, right? So if you are default alive, I think then you should not worry about it. You should just stay focused on the fundamentals, making sure that you are building and hitting those growth metrics that you are looking for to get to profitability. If you are not profitable, I think then definitely it is kind of a doomsday kind of a situation. And as a result, what you're seeing, layoffs happen left, right, everywhere, right? Because companies just cannot sustain those inflated team structures, which are not adding to the core sort of bottom line, right? And I think that pretty much answers, like, the default alive question just pretty much answers how you should be treating this scenario, right? So if you think you're default alive, you continue pushing all the right metrics versus trying to do sort of growth at all costs, right? Like, I think that those days definitely are over, at least for the next, say, 18 to 24 months, based on whatever the predictions are right now. I'm definitely not from a finance background, so can't say that this will definitely be over, but
I think in terms of guesstimating when this will be over, it's certainly, we'd be looking for a peak maybe in inflation, and hopefully inflation will start to subside, and at that point we can start to estimate more accurately. But I think there are just no signs of us reaching the peak as of now. So as our best guess is that this could continue anything from, well, it could be a V-shaped dip, or it could be a sort of a years long, even just, we could even just move into a recession. So I do know that some, like, in the previous years, some founders who I know typically ran their startups, and, without judgment, they would typically run until they have around 4 to 6 months of runway left. And then they would start the fundraising exercise and, get that capital closed. And what I'm seeing now is that, there are a few startups in this situation where it's sort of 6 months left, and it's very, very difficult to, suddenly sort of there's, raising funds isn't as easy as it was before. And that's when inevitably sort of layoffs have to happen, because you have to really look at, instead of raising cash in those next 4 to 6 months, becoming profitable, becoming self-sustaining. And it's a bit like a handbrake turn, to really pivot your business from being growth at all costs to being profitable, grow profitably at all costs. And so I think we just became, maybe as founders, a bit too comfortable with these sorts of tighter timelines. But just one,
sorry to interrupt. From your perspective as a founder, right? Like, have you seen an actual change as a CEO in your strategy, in how you're treating this before versus now, right? Like, has that actually made any strategic level impact in your thinking through on how to grow Bombay Play as a business?
Yeah, I think the in terms of burn rate, we've done, we've considered sort of streamlining the business, focusing on, getting to profitability a bit faster, and sort of keeping the burn as minimal as possible. I mean, to be honest, we have always, as Bombay Play, we've always sort of operated in this way, in a kind of more sustainable way. So as sort of the market took a turn, we found that it's only really smaller adjustments that are needed. And I could say, like, with our recent fundraise that we've closed, I think our runway is well over sort of 10 years at this point. So it's really like not in fact, burning more even makes sense at this point. I don't think you have to necessarily have to sort of streamline just because everyone else is. You have to, as a founder, really do a rain check and figure out where you are. And I think this sort of echoes back to the COVID crisis, when gaming was booming, when a lot of other businesses were actually suffering. So really a crisis for one isn't necessarily a crisis for all. And so yeah, I don't think the Bombay Play will be particularly affected here, but from what I've seen from other but in fact, first I'll turn the question on you, Mike. What has been your reaction to all of this?
I think very similar to yours, right? And I've generally seen this as a pattern in founders that are sort of more disciplined about this. That while in the VC world, it's common to think about runway in terms of, say, 24 months or 18-month kind of tranches, right? But like you mentioned, right? Like right now, your runway is like 10 years or something, right? Like same for us as well, right? Like right now, our theoretical runway is like 6-7 years easy, right? And the whole sort of, like fundamentally, we didn't have to change any strategy at all. We were always very meticulous in terms of every dollar spent, especially I think even like going back to that edtech conversation that we were having earlier. A lot of these companies, the biggest burn is either on the employee cost or on the marketing spend for acquisition, right? And we have been very methodical about it. Outscale right now is only 11 people full time, and every new addition we see, when do we need it, and we really question it, and really go about a very structured approach to thinking about adding every core new member to the team as well, right? So fundamentally, there's been literally, no change, but just that I think mentally as a founder, it has, at least for me personally, put me in a position to think more about this, even on a weekly basis, looking at the growth in terms of where is our burn, how much are we spending on marketing, whereas earlier I was maybe looking at it every 2 weeks, right? So I think just the frequency at which this is taking my mental mind share has increased, but structurally and strategically, it hasn't really impacted anything. I don't know if that makes any sense or not.
I have another question for you. Well, another observation of my own is that I'm not sure whether you've been following the sentiment around startups, especially on sort of LinkedIn and Twitter. But a lot of at times of layoffs, I think it's very easy to sort of blame reckless founders, blaming startups for not having a proper business plan, hiring too aggressively, messing with people's lives. And so actually, I've personally found that we've had to sort of justify like even more during, say, our interview process, like why people should still have faith in the startup ecosystem, and why this why it doesn't necessarily make sense right now for people to sort of move to more stable, established, bigger companies versus join a setup like us. Have you sort of observed that in your own work?
No, I think 100%. And this is heavily relevant just because we recently launched a new product offering called, which basically just helps working professionals in the gaming, non-gaming ecosystem get connected with companies in the gaming ecosystem who are hiring, right? So what we are observing as a pattern when we talk to all these highly talented candidates is, right, like a lot of them are inching towards, especially with the current macro scenario, inching towards opting in for like bigger, larger, well-established name versus younger startups, even though we know that these younger startups have rock solid, founding team with good track record. They've already either closed a pre-seed seed round. They're going to do some kick-ass work. And obviously, people who are joining them early, especially as part of the tech or the product focused teams, they get a lot of ownership and control, and the growth is phenomenal in terms of the learning curve, right? All those extra benefits. But I think fundamentally, what I've observed talking to a lot of talent in early / mid career stages in India is that we don't understand correctly how to assess risk, right? For example, right, when our prime minister locked out the first set of apps, Chinese apps from the country, right? Who would have expected that a company worth 100 billion plus, in this case ByteDance, would suddenly lay off the entire team, right? I think they did the layoffs in 2 tranches, right? So when we think about from a talent perspective about job security, right? We think about, oh, a bigger company naturally means more safety and security, right? But there are always these factors that are much beyond any individual's control, irrespective of how big or small a company might be, and that could come down to impacting your, individual stay / job security / financial stability, etc. Right? So my urge / sort of communication and advice to a lot of folks is usually around understand how to evaluate risk, right? Ask openly questions to the founders if you're coming into a younger startup around their financial situation. How are they profitable? Are they burning money through the hole? Who's their investors? How are they planning for future raise / product growth and new kind of aspects? Like we got to be a more open-minded towards understanding these aspects before jumping into the startup ecosystem. And whether it's gaming or broader tech ecosystem, I think the same sort of thought process applies. Once you understand that, right, then you know what are the kind of risks you're signing up for. So for folks who might be, having a negative reaction towards this itself, probably fundamentally don't understand the risk involved, right? I don't know if you'll agree or disagree, but at the end of the day, you're coming in early at a startup because of those inflated salaries, because of the equity that you get, and that leads to a higher payoff, right? Like what we talk about as generational wealth that gets created through startups, which will never fundamentally happen through a job at, say, Google / or any other bigger player, right? So I think those trade-offs, once you understand, you know what you're getting into, right? And then there is never discontent, even if something bad happens, because you know what you signed up for, right? So as an ecosystem, I think we need to do a better job of teaching about this stuff publicly, so that more people jumping in are encouraged to do it on the right basis and thought process versus running after FOMO.
Agreed. Like I've actually noticed this change, and I think Ajay, you had your hand up, so we'll just jump over after this if you wanted to add something there. But we've noticed during our interview process, like over the last month or so, is that the candidates have actually, but the smart candidates have really started asking questions about business performance metrics, which is it's a great it's actually a very positive thing in my eye, to have an active interest in how you're doing. But we typically hadn't seen this, like a candidate ask what our day 30 retention was for our games before joining. But I think once I think we interviewed a few people who were laid off from I think MPL. Ajay, do you want to, maybe you've got something to add around this, because I believe you did an interview recently.
No. Actually, my question.
No, okay, sure. I'll tell that story another time then.
Sure.
Sorry, did you have something to add?
No. I just wanted to take the conversation to a slightly different direction, which is so given this drying up of funds, right? do you expect, say, more scrutiny from VCs and with respect to, like, say, the performance of the company? And is there any pressure to, say, focus on more short-term or, say, cash flow-driven bets versus, uh, say, longer-term cash-burning bets?
I think well, either short or long. It's a good VC will be prudent enough to not look at not invest in a startup for a quick flip at any point in time, right? But in regards to the question on diligence, I really truly hope that diligence is it's more thorough going ahead. I think we've had a slew of unfortunate sort of fallouts between investors and founders over the last few months, wherein it's become sort of clear that there are some founders that have been inflating their metrics, of either knowingly or unknowingly. And personally, from what I've seen during various diligence phases, is that your financials are vetted well, but your analytics typically not so much. So I actually I sincerely hope that any VCs, any people listening, like how is retention calculated is an important question. How are MAUs counted is an important question. Uh, like I've seen some businesses count MAUs as just simply the sum of your DAU every day, which enormously like double counts your daily active users and inflates your MAU. But if you just but the thing is, like the accountants don't necessarily look into this every time, and are more interested in sort of the known things like your revenue. So it wasn't always. I wouldn't say it. I wouldn't say it was better or there was a golden era for this. I think as businesses have evolved and the KPIs have become more standardized, especially in the gaming space and just, I guess, digital content in general, as people have become more familiar with the KPIs businesses should be sort of showing in their MIS, and why downloads don't matter, and why retention actually is the real metric that people should be paying attention to. This is sort of known now, but what is not so known is how these are calculated. But the diligence, on the topic of diligence, I think in a founder friendly market, these periods have become very, very short, and could just be completed in a month or less. I remember with in my previous startup Moonfrog, sort of the diligence with Tiger Global, that was closed out in less than a month. But typically, a startup like the recent round we closed, I think it took about 3 months for the diligence to close, which is actually, I think, the sign of a more healthier sort of vetting process. And I do think it's good both for the investor and for the startup, really, that this kind of practice continues. I hope that answers what you're asking, Ajay.
Yes.
Cool.
Yeah, I think I'll just add one more thing there, that normally, similar to what Oliver mentioned, right? Like a healthy diligent process is definitely needed. But then again, right, like you got to understand that VCs are in the business of making money by giving money, right? They're in the business of selling money essentially, right? And the only outcome, like even Oliver was saying, they're never looking for like a short turnaround, because they are looking at how can they invest in something that can potentially, give them 10x the fund back, the entire fund back, right? And that's what the game that they are in, right? So while they'll be more stricter about the diligence process, they'll be more choosy about the bets they make. Money still fundamentally will be there, right? It's not that money completely goes down to zero, just that if there's 1/10 the amount of investments happening, then only the best of the best are the ones that get funded, right? So earlier, if you say a year back from now, if you were building in the Web3 space and you didn't have much of a track record for anything gaming or Web3 related, you could still at least on a solid business deck, you might still get the initial pre-seed round or a seed round, right? But now that's just gonna make it like tenfold harder, right? So while VCs would encourage that the companies still survive, but if they are making a diligence and a bet on a new company, it would be that they see that this can become an actual eventual outlier in some sense, right? Otherwise, they would never take that bet in the first place.
Yeah, absolutely. I just want to open up the floor at this point. If there's anybody, please do stick up your hand and we'll invite you to come up and speak if you want to engage in the conversation in any way. I just want to maybe also move on the conversation a little bit to who like some general questions here for you, Mike. Like, who do you think the winners and losers will be in this new kind of climate? Which kind of businesses? What kind of verticals? And how is that different from what we've experienced in the last, say, 5 to 10 years?
I think, like, are you talking about specifically gaming or just broadly overall?
Gaming, I think we've covered. Like, we know that, well, fundamentally, if a business is like in gaming content, I do believe that crypto specifically might be a loser in this market. And that's not because I'm hating on crypto or anything. It's just that the business model, especially the confluence that we're seeing between gaming and blockchain, the business models really aren't proven out yet. And a lot of the seed stage sort of fundings that we saw in the last year are really going to have to try and prove themselves out faster than what they otherwise would have had to in a normal, well, I say quote unquote, maybe we've been living in an abnormal market for the last 5 years, and founders in this era just think that was normal. But maybe it feels like well, first of all, crypto has the currencies have collapsed. Well, I say it's not a total collapse. Bitcoin has managed to hold at a certain point, but it's certainly a lot further down than it was last year. The NFT market, in terms of volume, has taken a big hit, although not as bad as some have said. I've had a look at sort of just prior to this call, just checked out the trading volumes on the major exchanges, and yeah, it is down, but it's not a complete collapse as some might say. So in other words, the crypto and at least the NFT project market, it seems like it will sustain at this point and isn't going to go to zero. But my worry is that businesses that were trying to build blockchain games, somehow they're going to have to do two things: work out a model that is profitable, and get the sort of and by getting the confidence of sort of investors. And I think after the crash, well, several crashes that we've seen in large crypto projects and hyperinflation, it's going to be hard for them to get to really get the confidence, and they're going to have to work out like whole new game economies that will work. I think that's that's more of a 5-year to 10-year problem than it is something that can be solved within this year itself. Yeah, so sorry, Mike, over to you. Like, who else do you think will be a winner or a loser?
Yeah, I think just on my sort of thoughts on just Web3 itself, I think there will be still solid companies building good value prop. I think we've both had this discussion that a lot of crypto focused games seem like games that are that have an added crypto angle just for the heck of it, right? so those one definitely.
I mean, Outscal has a Web3 angle. I've seen it on your shirts.
Yeah, because that's mainly from like a talent perspective, right? And talent will definitely be there in the market because this, I think we can all agree that from a macro trend perspective, adoption of Web3 in gaming and in tech is just going to go uphill from here, right? But even with, because the market, either the trading volume or the BTC price, everything can go down, companies will continue to build products in the space, right? Just that the kind of products that get built are going to be much different, right? Where everybody earlier was just making NFT drops after NFT drops, just from, you know, from the FOMO in the market. Now all of those have dried up, right? You see all those Discord servers, majority of them are completely dead, right? So I think from a core fundamentals again perspective, right? Like there are certain things that will always be needed, things that are more infrastructure play that let you build on top of it, right? And that's where I'm bullish on things like Ethereum slash Polygon will in the long run will be the long-term sort of winners versus the ones I think that are trying to chase the FOMO of, hey, there's a shit ton of money going into, the NFT drop space. Let's just create some random NFT out of it, which doesn't have any sort of a real external value associated to it, right? Like those completely went down to zero. I think this Jack Dorsey Twitter, the first tweet that he made was a good example, right? Like the person bought it for like some millions and a year later tried to sell it and it got an auction best price of like $16 or $20 or something like that. Like that was absolutely mind bonkers ridiculous, right? There's no real value to it, right? So that's what I mean, that things that do have real value, like for Outscale scenario, it's like the hard skills that folks acquire to build in this space, right? So I think those definitely will win in the long run, right? But generally outside, I think the Web3 space broadly, I feel SaaS definitely has a strong space already, and I think it's time and time proven again. There's a lot of movement happening in the future of workspace in terms of how remote is definitely a trend. I don't think it's going away, even though people might think it is, because COVID has sort of eased up and everybody's kind of going back to the office. But I think the remote as a forcing function got everybody introduced to the concept of remote, but how remote is going to shape up, it's going to be very different from what we know remote as of today, right? Like I think we've discussed this once, where I think you guys are experimenting with a distributed kind of a team model as well. Some team members, in the Bangalore region, others spread across the country or multiple countries as well. So I think those are the kind of more innovations once sort of the dust storm settles and the hype train comes down, we start to see the real picture kind of emerge, right? So I think those, for me at least, the spaces that I'm kind of closely related to slash following, like those are, I think, my macro picks. Anything for you, Oliver?
Yeah, I actually, despite what I said earlier, I do think it's the time to go bullish on in the Web3 space as other, I'll call them, for lack of better word, tourist founders who sort of try and capitalize on a hot kind of industry and sometimes enter it and raise money without having too much knowledge on the execution side. I think the tourist founders will, like, as soon as the market starts pulling back, they are sort of the first to go. And it's really, now is the time to execute in that space. And those who execute well, as you were saying, will inevitably be the winners. I think it's a really good thing that there's no rush anymore to execute and capitalize on a big upswing of investment pouring in. Actually, now we can take the time. We can just take the time to build something of real value and bet on the long term. And I think the true believers will stick behind and build that. So that's who I believe will, at least in the context of gaming, the winners will be the content makers and and those who are in it for the long haul. The losers will be the tourists.
No, I think I 100% agree. But do you think, I think we didn't get a chance to touch on anything related to impact on, say, the publishing side of the gaming industry, right? The developer publisher relationship kind of a thing as well. So do you think there's any sort of impact there because there are more developers, maybe less
Sure.
publishing money available, because at the end of the day, macro markets definitely have lesser liquid capital, right?
I think that topic is quite, there's quite a lot of depth to it. First of all, I mean, publishing in the gaming space has been evolving like over the last sort of 3 years or longer. It's been very data driven and has almost totally, at least in free to play, almost totally been overtaken by hyper casual game developers who only look for sort of day 1 through 7 retention, and if that's good enough, then it shall be published. But now we're facing this two things, I guess. The IDFA deprecation by Apple last year, which really made this particular genre of game less lucrative. And now, now we have this downturn which hope, well, I hope not, but might end up choking the content creators who are trying to scale on sort of Web 2. So, yeah, I mean, I do have hope for, I mean, even the successful publishing deals. I think we saw the Love and Pies developer acquired by Supercell recently. I think these sorts of strategic publishing deals will always exist, but they're still relatively rare. I think what publishing has really become is a way for hyper casual developers to sort of decentralize their development capacity and engage anybody from sort of a college student all the way, to a team of, just small teams all the way around the world, so that they can test as many games as possible in a short amount of time as possible. And I think that would still exist, and as the model has been proven at a high enough scale. But overall, I don't think the macro funding environment will, as you say, like dislodge any of the leaders. But it's really these at the grassroots. I think grassroots content creators. We may see less innovation in the gaming space, just as people become more cautious, which is it's not a pleasant thing to think about. But I do hope that companies do step up, and where funding maybe is not coming from VCs, we'll see more strategic stepping in.
Interesting. I think we should definitely host a separate conversation around just this topic in terms of how we think about the future of this whole industry, because I know a lot of indie developers, smaller studios who are really building strong passion projects which can have good visibility if they get the right publishing deal with it, right? So, and on the other side, bigger studios slash companies, even like Nazara, who have access to a lot of IP, are always looking for solid teams to help them build good quality content as well, right? So I think there are very different kind of nuances depending on what kind of a genre you're looking at. Yeah, this might be an interesting separate conversation, but definitely a longer one than what we can do today, probably.
Yeah. Shall we just wrap this up then? Like, any advice for seed stage entrepreneurs at this moment who are trying to start up?
Yeah, I think again, fundamentals. I keep harping on that same point, like a broken, arrow. But that's exactly what you need to be focusing on, making sure that you're focusing on the right core metrics, right? For example, rather than trying to acquire a lot of new user, how can you sort of think about retaining your existing ones, right? Instead of spending every new dollar on, ad spend for acquisition, how can you increase your lifetime user value from your existing users and maybe reroute your dollars there itself, because there if you deliver a much better experience or a much better service, etc., right, like you definitely already have those users eyeballs, right? So I think just using those kind of a solid fundamentals approach, and like that's what at least at the seed stage people need, being very cautious about the burn, limiting, not going over hiring, because over hiring is probably at the seed stage the most common reason that we see around, that companies do later regret, and thus the layoffs. So yeah, I think those two things I would say majority folks need to sort of focus on, at least in the early stages, and especially pre-product market fit, right? Anything you want to add as well, Oliver?
Yeah, I would say don't, if you have a great startup idea, I would say don't look to the macroeconomics to determine whether you should or should not, take the plunge. It's a good business is a good business in any sort of climate, and some of I think the saying goes, some of the strongest businesses are built in the worst sort of in the worst markets. I think there's a quote from Warren Buffett who says, be fearful when others are greedy, and be greedy when others are fearful. And I think it makes total sense. Like there's going to be less competition now. There'll be fewer tourists, and those who are committed to start a business at this stage obviously will have a lot of conviction. And I think that having conviction and having confidence in your business goes a lot further than, cash in the bank.
Yeah, absolutely, 100% agree. I think I love the tourist founder analogy, and it's like the best. It's always a well-known fact, right? Like some of the best iconic companies have been born out of the most, worst of the market situations, right? So, so I think this is where it's time to focus on building, right?
Okay. So on that note, I think we'll wrap this up. Thanks, Mayank, for jumping on here, and thanks everyone who tuned in. The recording will be up on Twitter for anyone who wants to listen to us struggle with audio for the first 5 minutes and then get into the conversation from the start. All right, I'm going to be ending the space.
All right,
Thank you.
thanks,
Have a good
everyone.
weekend. Bye-bye.
All right, take care, guys. Bye.